Imagine you're sitting at your desk, right? You're totally dialed in, waiting for that non-farm payrolls release.
Oh, the classic setup.
Exactly. The numbers flash across the terminal, your setup looks absolutely flawless, and you hit buy with, like, complete confidence. But then 3 seconds later, an algorithmic spike tags your stop loss, slips you by 3 points, and then immediately rips 50 ticks perfectly in your original direction.
The absolute worst feeling.
Right. You just watched a whole week's worth of profit vanish while the market just casually marches toward your target without you. And, well, what you do in the next 5 minutes is going to dictate whether you survive as a trader or permanently blow your account.
Welcome to the Franks Report. I'm Jessica.
And I'm Phillip.
And we're diving into some really intense territory today. But before we unpack all the psychological warfare happening inside your own head, just a quick reminder to follow us for future deep dives.
And if you're navigating the modern prop firm landscape, you really need to pick up a copy of our book. It's called The Funded Micro: Modern Futures Strategies for the Prop Firm Era. The psychological traps we're dissecting today are the exact hurdles that keep traders from getting funded.
Yeah, and a huge thank you is also in order for our sponsor, TradingView. For those of you who are actively charting your execution zones, TradingView is, frankly, simply the fastest way to follow markets.
It really is.
Yeah, and you can save $15 when you use the referral code in our description to obtain the business standard tier. I mean, it provides the pristine data you need when the volatility spikes like that.
Absolutely. So today's mission is a deep dive into basically the darkest corner of trading psychology. We're talking about revenge trading.
It's a heavy one.
It is. We're looking at the biological imperatives that kind of force your hand, the cognitive biases that construct this false reality on your charts, and the mechanical interventions you need to basically cage your own worst instincts.
Right. Because revenge trading isn't just a lapse in judgment.
No, not at all.
It's that terrifying moment where a calculated probability matrix just morphs into this deeply personal, almost violent vendetta against the market itself.
Yeah, a vendetta is the perfect word for it. And I think what's so fascinating is that shift from probability to vendetta. It's entirely biological, right?
No, 100%. When you strip away the screens, the candlestick charts, the broker platforms, you are left with a piece of human hardware that, evolved over millions of years to survive in the wilderness.
Right, running from lions.
Yeah.
Not trading futures.
Exactly. It was not built to process complex financial risk. So revenge trading is ultimately a failure of our environment, not just a failure of willpower.
Wow, okay.
Yeah. When you experience a sudden jarring financial loss, your brain doesn't just look at it and go, oh, statistical variance. It actually perceives it as a literal threat to your survival.
Because I guess on a subconscious level, money equals resources, right?
Right.
And a sudden loss of resources triggers the amygdala, which is the brain's ancient alarm system.
You nailed it. It's treating a flashing red P&L the exact same way it would treat a predator jumping out of the brush. You get this huge surge of adrenaline, your blood pressure spikes, and your body is literally preparing for physical combat.
Which is wild. And that initiates what's called an amygdala hijack, right?
Yes. The emotional processing center of your brain demands so much metabolic energy to deal with this perceived threat that it just starves the prefrontal cortex.
And the prefrontal cortex is the logical part.
Exactly. It's the executive command center right behind your forehead. It handles logic, statistical probability, adherence to your trading plan. But when the amygdala hijacks the system, that logical center just goes completely dark.
So your brain basically unplugs the math department.
Totally. Your primary objective instantly shifts from executing a defined edge to seeking immediate, desperate relief from the psychological pain of that loss.
It makes me think about the mechanics of road rage.
Oh, that's a great comparison.
Yeah, because if you're walking down the street and someone physically lunges at you, a sudden surge of aggression might save your life.
Right.
Right? It's an appropriate biological response to a physical threat.
Sure.
But if you're driving on the highway and someone just cuts you off in traffic, your brain triggers that exact same survival aggression.
Right, even though you're safe in a metal box.
Exactly. Suddenly you're gripping the steering wheel, you're accelerating, you're tailgating a 2-ton vehicle at 80 miles an hour just to, quote unquote, teach them a lesson.
But the highway doesn't care how angry you are, and the market certainly does not care about your personal need for vindication.
The market definitely doesn't care.
Not even a little. When you bring that primal aggression to a trading terminal, it just manifests as compounded execution errors. You start managing risk, you start swinging for the fences, you act on this delusion that the market is a physical opponent you can somehow intimidate or beat into submission.
It's so true. So let's trace how this biological hijack actually plays out on the charts. Because the cycle is, well, it's incredibly predictable once you know what to look for.
It really is. And it rarely begins with a standard expected loss that fits neatly into your risk parameters.
Right. It's never the normal paper cut.
No, it almost always begins with a trigger event. Kind of like that NFP scenario you mentioned earlier. It's the loss that feels deeply unfair. The slippage on a news wick, a platform glitch, or that stop hunt that tags you by a single tick before the massive reversal.
Oh, the one tick stop out. That is just agonizing. And that sense of unfairness, that acts as the catalyst for the first major psychological shift, right? The ego bruise.
Yes, the ego bruise. In a rational state, a trader knows the market is just an impersonal auction mechanism. But post-trigger, all that objective analysis just dissolves.
You start taking it personally.
You do. You feel targeted. You personify the price action, convincing yourself that, institutional algorithms or market makers are actively hunting your specific liquidity.
Like they're looking at your account specifically.
Exactly. And once you assign malicious intent to the market, you are no longer trading your system. You are just defending your pride.
Which drags you directly into probably the most insidious part of the cycle. The justification phase.
Oh, yeah. This is where it gets really dangerous.
Because you don't just blindly click buttons, right? Your compromised brain actually builds a whole narrative to rationalize the upcoming revenge trade.
Right. You'll drop down from your hourly chart to, a 1-minute chart, desperately hunting for some microstructure that supports your need to get back in.
You start drawing phantom trend lines.
Yes. Or heavily weighing some minor moving average cross that you normally completely ignore. The justification phase is terrifying because it uses the language of logic to mask an emotional reflex.
It's like you're creating an alibi.
That's exactly what it is.
Yeah.
You convince yourself you're executing based on technical analysis, but your prefrontal cortex is offline. You're actively lying to yourself to satisfy the amygdala's demand for immediate action. You start telling yourself, well, the market owes me a mean reversion because it dropped too fast.
Which is a concept completely devoid of actual market mechanics.
100%. You build a fundamentally flawed premise, and that launches you right into the escalation phase.
Which is the sizing up phase, right?
Yeah. To neutralize the pain of that previous loss instantly, you bypass your standard position sizing altogether. If your business plan mandates risking, say, 1% per setup, you suddenly load up 3, 4, or 5% on this fabricated trade.
You're just trying to erase the red on your screen with one massive home run swing.
And the fallout is mathematically devastating. Because the escalated position is built on desperation rather than a back-tested high probability edge, it's just highly likely to fail.
And when it does fail,
the loss is exponential. It pushes your account into a drawdown so deep that standard risk management can't even recover it anymore. The panic compounds, the sizes get even larger, and within a matter of hours, an entirely funded account is completely blown.
it happens so fast. So to build a firewall against that kind of rapid destruction, we really have to isolate the cognitive biases that make us vulnerable to that initial trigger loss.
Definitely. It's not just the adrenaline, it's how our brains fundamentally misinterpret probability.
Right, like recency bias. That plays a massive role here, doesn't it?
Huge. Our evolutionary hardware is designed for pattern recognition. So if a hunter-gatherer found a predator by a specific riverbank yesterday, their brain prioritizes that recent data to keep them away from the river today.
Which makes sense for survival.
But in financial markets, recency bias forces you to heavily overweight the outcome of your last trade. If you just took a loss, your brain projects that loss forward, creating the illusion of a permanent losing streak. It generates this false sense of urgency to fix the trajectory immediately.
And I mean, it swings the other way too, right? A string of 3 consecutive winners just floods your system with dopamine.
No, absolutely.
You start feeling invincible. You assume your read on the order flow is just flawless. And that overconfidence is the perfect incubator for a revenge trade. Because when the inevitable loss finally hits, The contrast between your inflated ego and the cold reality of the market is so jarring. The emotional snap is just much more violent.
Yeah, the whiplash is brutal, and following right alongside that is loss aversion, which is, a cornerstone of behavioral economics.
The idea that losing hurts more than winning feels good.
Exactly. The psychological pain registered from losing capital is roughly twice as severe as the satisfaction gained from an equivalent profit. Losing $500 physically hurts more than making $500 feels good.
Okay, wait, let me push back on the framing of loss aversion as a negative bias, though.
Sure, go ahead.
Because the entire foundation of professional trading is capital preservation, right? If my biological imperative is to aggressively protect my money and hate losing it, shouldn't that inherently make me a more risk-averse, cautious trader?
You'd think so, right. But that is the ultimate paradox of trading psychology. In theory, hating loss should make you protective. But in practice, the desperation to avoid realizing a loss causes you to take on catastrophic, asymmetrical risk.
Oh, like refusing to close a bad trade.
Yes. When a trade starts moving against you, loss aversion makes it agonizing to accept the small, planned hit to your account. So instead of letting your stop loss execute, you engage in passive revenge trading.
Passive revenge trading, wow.
Yeah, you manually drag your stop loss wider, giving the trade, quote unquote, more room to breathe.
Yeah.
You hold on to a structurally broken setup, praying for a reversal, simply because you cannot stomach the immediate reality of a tiny scratch.
So you basically trade a small, controlled paper cut for a slow, fatal bleed. You end up risking 10% of your account just to avoid locking in a 1% loss.
Precisely. And that desperate hope is usually fueled by another bias, the gambler's fallacy. Humans crave equilibrium. If we see a market sell off aggressively for 5 consecutive 5-minute candles, our brain insists that a green candle is quote-unquote due.
Like, it has to bounce here.
Right. We believe the market owes us a reversion to the mean just to balance the scales.
But the market has absolutely zero memory of the last 5 candles, let alone your personal P&L.
It really doesn't.
It doesn't know your account balance. It doesn't care that you just took 3 consecutive losses.
Yeah.
I mean, every single tick, every single order that hits the tape is an independent event driven by participants who have no idea who you are. The probability of your next setup working is entirely disconnected from the outcome of your last execution.
Exactly. But diagnosing these biases and biological responses, that's only half the battle. Insight alone isn't going to save your capital during an amygdala hijack.
Because you can't outthink it in the moment.
Right. When the logical brain is offline, you cannot rely on willpower to make rational decisions. You must implement mechanical interventions, like hard and soft controls, that completely remove the element of choice when your emotions spike.
Okay, let's focus on those hard controls first, because these are basically your ultimate safety nets. And the most non-negotiable tool in your arsenal should be the daily loss limit.
Absolutely. This is a predefined maximum drawdown for a single session, say 3% of your total capital.
But the trick is how you implement it, right?
Yes. The critical implementation of a daily loss limit is that it must be hard-coded into your broker platform or API. You can't just stop at 3% on a sticky note attached to your monitor.
Because you'll just peel it off and keep trading.
You will. You have to configure the software to literally lock you out of order execution once that threshold is breached. You're essentially hiring a digital bouncer to revoke your access to the exchange when you're entirely compromised. It prevents a bad morning from spiraling into an unrecoverable, career-ending afternoon.
That is so crucial. And complementing that API lockout are the soft controls, specifically the physiological cool-down rule.
Yes, the cool-down rule is vital.
Because after any loss, even a perfectly executed low-risk setup that just didn't pan out, you force yourself out of the chair. You literally walk away from the monitors for 15 to 30 minutes.
The physical distance is a biological requirement. When the amygdala triggers that fight-or-flight response, your bloodstream is flooded with cortisol and adrenaline. You cannot simply take a deep breath and immediately process order flow objectively.
It's just not physically possible.
It's not. It takes actual time for those neurochemicals to metabolize and clear your system. By stepping away for a half hour, you allow the prefrontal cortex to boot back up and regain executive control.
Makes total sense. You also need absolute rigidity in your position sizing, too. Your sizing model has to be mathematically decoupled from your emotional state and your previous trade result.
Right. Stick to the plan.
If your system dictates risking 2 micro contracts per setup, you execute 2 micros. If you try to double your size to 4 micros just to aggressively recover a previous loss, you just destroy the mathematical expectancy of your edge.
Sizing up during a drawdown is mathematical suicide. As your account shrinks, the percentage gain required to get back to break even grows exponentially.
Right, because of how the math works.
Exactly.
Yeah.
If you lose 50% of your account, you do not need a 50% gain to recover. You need a 100% gain just to get back to zero. Standardizing your size ensures you never face those impossible recovery hurdles.
And tracking all of this requires a pretty profound shift in how you journal, doesn't it? A professional trading journal is not just a spreadsheet logging your entry price, exit price, and P&L. It has to be an emotional diagnostic tool.
Oh, absolutely. You must document your psychological state the moment you enter the trade and the moment you exit.
Because you're hunting for patterns.
You're hunting for the psychological precursors to a spiral. When you audit your journal on a weekend, you might see a note that says, "I was furious that I missed the morning breakout, so I forced a trade in the afternoon."
Or, I just wanted to make back the prop firm evaluation fee.
Exactly. Those entries are the raw symptoms of revenge trading. By identifying the specific environments that trigger your worst behavior, you can build custom rules. You realize you're emotionally volatile during Fed rate decisions, so you mandate a rule that you simply do not trade FOMC days.
Okay, let's address the most urgent scenario for anyone listening right now. What if you catch yourself mid-spiral? You're sitting at the desk, your heart is hammering against your ribs, you realize your position size is 3 times your maximum limit, and your stop loss is completely deleted. You are actively in a revenge trade right now. What is the immediate protocol?
The immediate protocol is brutal but necessary. You flatten the book.
Just close it all.
You close the position instantly at market price. You do not wait for a small bounce. You do not wait for the candle to close. You do not hope it gets back to break even so you can exit gracefully.
You just take the market order execution and absorb whatever the loss is in that exact second.
You absorb the loss because that position was constructed by a compromised brain. It is an emotional reflex masquerading as a trade. It has zero mathematical expectancy and no place in a professional portfolio.
Wow.
Hitting the close all button is not an admission of defeat. It is an active reclamation of your discipline. You are taking the steering wheel back from the amygdala.
And once that position is closed, the session is over. You walk away and conduct a brutal post-mortem on your environment. Why did the guardrails fail? Were you heavily sleep deprived? Were you carrying immense stress from an argument in your personal life? External friction absolutely decimates your capacity for emotional regulation at the terminal.
It really does. But you know, guardrails and API lockouts are vital for surviving the immediate danger. Long-term survival in this industry, though, requires a fundamental cognitive reframing of what a loss actually represents.
You have to change how you see it.
As long as you view a losing trade as a personal failure, a reflection of your intelligence, or an insult from the market, you will always be susceptible to the revenge cycle.
You basically have to completely detach your ego from the red numbers. And I think the best way to process this is by treating your trading account like a traditional brick-and-mortar business.
I love this analogy.
Right. Think of a local coffee shop owner. At the end of the month, they have to pay their lease, their electricity, and their payroll. They don't look at the electric bill, feel personally victimized by the power company, and try to burn the building down in retaliation.
Hopefully not.
They understand that electricity is simply the cost of doing business. It's the necessary overhead required to keep the lights on and generate revenue.
And your stop loss is your electricity bill.
Yes.
It is the mandatory operational overhead required to interface with the market and extract the next winning trade. You are paying a small fee to test a probability zone. When you deeply internalize that losses are just statistical distributions built into a profitable system, the urge to fight the market vanishes.
Because there's no emotional grievance to settle.
Exactly, because you expect the overhead. The flashing red P&L is no longer a tiger in the brush, it's just a routine line item on a ledger.
Depersonalizing the market really is the ultimate hack for longevity. So let's pull all of these threads together. Revenge trading is not a character flaw. It is an ancient biological survival mechanism misfiring in a modern financial environment.
Perfectly said.
You cannot outthink an amygdala hijack in the heat of the moment. You must build hard, mechanical system controls to restrict your access, standardize your sizing, and reframe your inevitable losses as routine business overhead.
Survival dictates respecting the biology. You build the cage before the tiger wakes up.
We really hope this deep dive arms you with mechanical and psychological defenses necessary to protect your capital. Be sure to visit www.despayfranksreport.com to dive even deeper and grab your copy of The Funded Micro, Modern Future Strategies for the Prop Firm Era. And follow this deep dive wherever you get your audio so you're always up to date with our latest strategies.
It's always a privilege to dissect these markets with you.
Always. But we want to leave you with a final provocative thought to carry with you. We just spent a significant amount of time exposing how our ancient survival instincts violently hijack our logical brains in front of a trading terminal. But the terminal is just one environment.
That's very true.
Ask yourself, what other areas of our modern financial lives, our aggressive real estate bidding wars, our panic selling of retirement portfolios, our accumulation of consumer debt to maintain social status, what else is being silently directed by these exact same primal mechanisms? Until next time, stay curious.